The European auto stocks are tanking. I don't know whether you notice, but this sector is making headlines and all for the wrong reasons. Once considered a stronghold of innovation and performance, companies like Volkswagen, BMW and Mercedes are facing some tough times. But the big question is, are these companies now a great investment opportunity or just a trap for unsuspecting investors? Let's delve together into the details, but before doing so, press the subscribe button down below, smash that like button and share this video with your friends in order to make the channel grow. And now let's get into this. So what's happening to the European auto sector? Right now the Stoxx 600 Autos and Parts Index, which tracks the performance of the biggest European car makers, is among the worst performance in 2024. In fact, most of its components drop as much as 60% from the peak of this year. On top of it, financial analysts predict a 13.6% drop in earning generation potential for auto stocks, still in 2024. And it's no surprise if you consider all the challenges that these companies are facing. First of all, there is a massive technological shift towards electric vehicles, where they are facing fierce competition from Chinese producers. At the same time, customers are becoming more price cautious, especially with inflation biting into their budgets. Talking about the Chinese newcomers like BYD, that is among the most favorite Chinese stocks of Warren Buffett, that is not a newbie investor at all, are pushing hard into the European market, making life harder even to European auto giants. This is forcing companies like Volkswagen, for instance, to make tough decisions. And we can say that some of these decisions are pretty unpopular. They are clashing with trade unions, mainly on unprecedented factory shutdown, notably in Germany, driven by both rising costs and Chinese competition. Plus, we have to take into consideration serious regulatory risk that will force all European automakers to go full electric by 2035, implying tremendous restructuring costs to turn a business from petrol to electric. Now, talking about valuation. If you are a value investor, you may be thinking that actually stocks trade at a cheap price. And with an average price earning of 5, they may sound like great buying opportunities. Also, if we run a relative valuation against the broader market, we can see that auto companies are trading at 60% discount. But here's the kicker. Even with these low valuations, big institutional investors are staying away. Just to mention some, a Bank of America survey showed that autos are the most underweighted stocks among regional fund managers, while quoting Ralph Gunter from UBS disclosed to the press that valuations are really cheap, but we are not pushing the sector at all. Gunter warns that a toxic cocktail of weak demand in China, that by the way is one of the biggest buyers of European cars, plus falling car prices and higher labor costs, could lead to a further 10-20% drop in the share prices. And here I open bracket because the price pressure on the cars comes especially from China, which auto industry leverage a lot from state subsidies and lower production prices, generating all in all a negative loop. Anyway, it is not just about external competition. European automakers are facing slowing demand, especially for the EV offering. In fact, just in August 2024, European car sales dropped by 18%, with electric vehicle sales dropping by a staggering 44%. This is a particularly bad news for all those automakers that invested massively on electrification, like Volvo among the many, which recently scaled back from its plan to go full electric by 2030. So, long story short, what does this mean for investors? First of all, we don't need to be geniuses to understand there is a profit-warning talk ahead. Plus, some investors call it a value trap. That means these stocks look cheap on the surface, but without a clear path to recovery, they might not be worth the risk. In addition, backing exactly this aspect, Renault's CEO warned that European car makers could face up to $20 billion in fines if they fail to meet European carbon emission by 2025, further adding to the challenges of the sector. Last but not least, there is the trade dispute between the EU and China, notably on import-export taxation. which could put additional pressure on the European auto market. So let's say that all in all, regulatory risk is one of the main problems for the industry. Long story short, should you be investing in these stocks or not? Because here is the dilemma. While the valuation are tempting, we are pretty sure that we are not yet at the bottom of the bad news. And this sector needs a massive transformation, both in the supply chain and with regards to the EV infrastructure. And these two big issues must be fixed before we can expect a full recovery. This is pretty clear. So, from a personal standpoint, as a former investment banker, I can tell you that investing in auto stocks right now is risky because we can expect further drops before a recovery takes place. But for those ones with high risk tolerance who believe in the long-term potential of the European auto industry, notably navigating this technological shift, there might be opportunities. But let's be frank, this applies to every kind of investment because it's all about finding out a good business and be patient enough to see convergence between the earning generation and the stock prices. In these terms, I find extremely useful the strategies of Thomas Kaplan that advocates investing in good businesses that are not fancy anymore to become trendy again.
And so when you see these cycles and you understand human psychology and fear and greed, the history gives you a great perspective. And so if you own the assets and you don't go into debt, it really becomes a function of time before you become fashionable again.
And Peter Lynch, that reminds us that just in case the stock discounts already tremendous thing, this limits already by definition the downside risk. In substance, I would like to stress once again the importance of doing your research and understanding the risk involved. European auto stocks may be at historical lows, but the road ahead is filled with uncertainties. That's for you to decide whether they are actually good opportunities or a value trap. But of course, we will keep a close eye on the sector. Guys, before saying goodbye, don't forget to press the subscribe button, leave a like and share this video, because this will help me a lot growing the channel and the community, so to provide additional videos like this one and much more. Thanks for watching and don't forget to leave your comments down below. Invest wisely and see you in the next one. Cheers!